Hey everyone, I usually focus my videos on commercial real estate demand drivers, and that's with good reason. Generally, there are a lot of nuances affecting the space demand of each commercial real estate property type. Those drivers could be global, national, local, or even on a sub-market level. But demand is only half of the commercial real estate performance equation. The other half is supply, particularly new supply. So this week, I'm going to focus on the new supply outlook and how it's affecting commercial real estate in 2024. But before I drill into how many millions of square feet and how many new units we expect in 2024, I do want to touch on construction costs. Generally speaking, construction costs surged during the pandemic as supply chains broke down, but prices generally stabilized in 2023, and they've been relatively consistent for about a year. Lumber costs are running about 16% higher than before the pandemic. Steel prices are about 65% higher, while aluminum now stands about 52% higher than its average price from 2019. Concrete costs have been rising at a slow but steady pace and are about 39% higher than in 2019. And finally, there's construction labor costs, which now stand about 21% higher than their 2019 levels. To sum it up, the Federal Reserve's Consolidated Construction Material Index has been pretty stable since the beginning of 2022. Overall, it's about 26% higher than it was in 2019. The other significant cost dimension I should mention is the interest rate on construction financing. Currently, construction financing is in the 8% to 10% range, but back in 2019, I think it was generally running in the 5 to 6% range. So, depending on the property type, location, financing used, etc., construction costs are up by approximately 25 to 50% compared to where they were prior to the pandemic. Now, I'm going to focus on the new supply trends of the four main property types, starting with office. We're expecting about 67 million square feet of new office to come online in 2024, which seems like a lot considering that office vacancy rates are forecast to reach an all-time high 17.8%. But construction is roughly half the level we saw in the early 2000s, and I think the majority of the pipeline is built to suit, mostly in the suburban areas. Another property type with a thin construction pipeline is retail. We're forecasting about 40 million square feet to come online in 2024. That's about 75% below the construction pace of the early 2000s, and about 70% of the expected completions will be single-tenant retail properties. Retail construction has been down significantly since the global financial crisis, and that's part of why the retail sector's outperforming with a forecast vacancy rate of 4.8% in 2024. That's just a bit above the 4.6% record low of the third quarter last year. At the other end of the construction pipeline spectrum, with record or near record deliveries, are industrial and multifamily. We anticipate the completion of about 360 million square feet of industrial space in 2024, which is coming off the addition of about 400 million square feet in both 2022 and in 2023. For about 8 years straight, developers have been growing the inventory of industrial space by about 2% per year. Industrial vacancy rates increased by a significant 170 basis points in 2023, and we expect the vacancy rate to rise by another 80 basis points to 6.1% in 2024, about on par with where we were at the end of 2014. Now, apartment construction is expected to set a new record in 2024 with the addition of 480,000 new units, an inventory increase of about 2.5%. We expect those completions to bump the vacancy rate up by 30 basis points to 6.1%, which suggests a very solid level of net absorption this year, about 390,000 units, one of the better years on record. But here's the thing. The US still faces a housing shortage on a macro level, somewhere around 3 million housing units. And the cost of homeownership is out of the reach of most. Only about 25% of US households could qualify for a Freddie Mac mortgage on a median-priced home, even if they had the needed down payment. The affordability gap between the average monthly rent and the monthly house payment on a median-priced home is about $1,300 per month, an all-time high. So while the huge wave of apartment construction is needed, I think the completions will outpace absorption in 2024. That said, the apartment construction pipeline thins pretty significantly in 2025 and beyond, suggesting that demand will once again outpace new supply within the next couple years. That's why investors should always monitor new construction. New supply can radically shift the market equilibrium and dramatically impact the performance of existing assets. That's just one more reason investors need to keep their eyes on the horizon.